Let's get to the futures pits this morning, and it's going to be an interesting day. Brian Battle at Performance Trust Capital Partners joins us. And just to recap on yesterday, Brian, I mean, retail sales was not enough to impress the market. It took some sort of random report in the afternoon about potentially rescuing homeowners to come back 250. Did you believe that was the reason for the rebound?
Some of it, you know, it's funny. This is a business channel, and it's turned into a public policy show because of the influence of Washington. I think there's a couple of things that happened yesterday. You know, Tim Geithner came out Tuesday at his debut, and he got raspberries from the market because of no real description on how he's going to save the financial system. He's got another chance at the G7 to make a good impression. I think Steve Liesman's right. They're going to try and prevent a race to the bottom. We can't have another Smoot-Hawley or another protectionist era waving into the world, because that leads to nothing but trouble. Yesterday's news probably was that the stimulus plan, or the spending plan, is probably going to get done. The conference bill is done. We haven't seen all of the details yet. Some of that stuff is coming out, so it's going to go through. I think one thing that might have helped is somebody leaked some of the details that the foreclosure mitigation might include just a subsidy for lowering interest rates. That's good news for mortgage bond holders, because it doesn't look like you're going to have your principal reduced willy-nilly by a judge. That might be later, but this plan looks like all Congress will do is just subsidize lowering of the interest rates.
Right, and we got to get through today ahead of a three-day weekend. I mean, foreclosures were down in January from December, about 10%. The bank CEOs say they're going to lay off for a few weeks as the government tries to get a plan together. We had the retail sales numbers. Is there enough building there that we can at least, I don't want to say build a leg up, but at least stop this horrible week? It's been a horrible week.
Well, it's a terrible week, but you got to remember the stock market is a future earnings discounting machine. So what is in the economy? What's in the system to make earnings grow? And you know, we're saving ourselves, and we might be arresting the downward plunge, and that might be okay. But we're doing it with government spending. We're not actually growing the economic pie, it doesn't look like. So we might be holding tight here for a while, but there's nothing to make stocks go higher for, it seems like, the rest of this year, because the spending plan really doesn't address growth or how to make the economy bigger. It just redistributes the proceeds from treasury bond sales into the economy. It'll have a short-term bump, might keep unemployment from going down, but not a big stimulus for growth, doesn't seem.
Yeah, somebody yesterday tried to compare it to palliative care. I mean, like a painkiller, as opposed to an actual treatment for the disease that we're all in, which gets back to the original point that it's going to be hard for us to get real traction until we get some, at least signs that private capital is on board with this plan, this bank rescue plan.
Right, and if private capital would enter, you know, and this is an old axe that I've been on too, is that there are things that are preventing the recovery. One is, you know, I'm gonna say it. Becky's gonna cringe. The mark-to-market debate that's going on, and it's really not mark-to-market. It's what you do at that fair value. How much should banks get charged if an asset is impaired? Should they write it down to whatever the cash value is or whatever its intrinsic value is? So yesterday there was a great story in the Journal. Holman Jenkins wrote a nice story about why don't we try that? It's free, and let's see what happens. You know, the banks are going down and down and down. We're pouring money into the top of the capital system, and it's getting drained out by regulatory fiat. So why don't we give it a try and see what happens? Because the banks certainly the trajectory right now isn't good, so let's try something that's free.
It is free, but it is a complete change of the rules at a time where people are craving consistency over a lot of other things.
And doesn't it put off the idea that you would have private capital that would actually step in and feel comfortable with things to that point? We had Oren Kramer here yesterday, along with our guest host, who was very smart about this. He said, you know, he would buy at this point, but you're not going to buy if you don't know what's really in there and if people don't mark this stuff down. How do you get more private capital in?
Great point. I think financial institutions, it's not just banks too, it's insurance companies and it's long-term asset holders. If you just disclose, this is what the market would pay for me, this is the price, and this is Santulli's point. The price is the price, no disagreement. But a bond has inherent value. You get principal and interest, like a mortgage bond. You get principal and interest. That's a lot of the value, inherent value in that asset. Say, this is what the price is, this is what we think the inherent value is, we're marking it to X. Fully disclose it. And if it's fully disclosed, investors can decide if that's a reasonable price, and then over time, the investors will decide whether you're being reasonable about your expectations of that price. So we'll let the market decide whether you're good or bad on your pricing, but what it will arrest is the perpetual markdown of assets that all financial institutions are taking. We have to arrest that. We have to stop the decline before we get a recovery. So I'm for full disclosure. I'm for fair value. I think fair value is important. We know what the price of stuff is, but to force institutions to write it immediately off capital, how much the market discount is because there's no liquidity.
Does that work on the way up, too, though? If prices are rising very steadily?
It did.
You don't get to count them for whatever you think they're worth at that point? You don't get to mark it up to your bottom line?
This is part of the reason we're in this problem is it's pro-cyclical. It exaggerated a lot of the prices in 06 and 07, or 05, 06, and 07. So we're seeing the bottom side of this. Obviously, everybody knows assets were overpriced. You know, we had a bubble. Now, using the same system, you have to agree that we're probably underpriced using the same system. So it exaggerates on both ends. I think if you just fully disclose it, let the investors decide whether or not your mark is good or bad instead of imposing a markdown due to a lack of liquidity.
Yeah. Well, it's too bad we didn't invest. Times has a great piece on these muni bonds that were issued in 1868 that are just coming due, and others, they've issued others that are due, come due 2147. So if you're investing for the long term, that's one opportunity.
Yeah, great. Muni market's always a great investment.
Exactly. Thanks, Brian.
Okay, sure. Take care. Thank you.